Welcome to Card Table Commentary. I'm your host, Seymour Peterson. In installment number 10, we enumerated some reasons why it was going to be difficult to get economic growth going again in the 2000s. The Federal Reserve tried to help out by bringing short-term interest rates, especially after 9/11, down to the lowest level that they'd been at since the 1950s. But then there appeared to be salvation in the form of real estate. Nobody seems to have really planned this. I don't think there was a meeting at which they decided to stimulate real estate to stimulate the rest of the economy. I don't know that it was part of anybody's real plan, but rather it seemed to be an outgrowth of a long term desire to increase home ownership, and it was aided by our friends in the financial class that devised new ways to add new homeowners where there hadn't been. And of course, as a result, they would earn new fees for themselves. Whatever it was produced some impressive statistics. Between 2000 and 2006, the rate of home ownership increased from 67 to 69%. Housing prices increased by 84%, and home mortgage debt increased by an eye-popping 124%. Many of these new mortgages were refinancing, where people would take their equity out in terms of cash out, and then they would pretty immediately spend it on other things in the economy. So it had a great stimulative effect on everything. It was indeed a real estate mania, but nobody seemed to be bothered by it at the time. Ever imaginative when it came to opportunities to earn new fees, the financial class devised many new ways to produce homeowners. There were no money down mortgages, and there were mortgages with teaser rates that were very low for the first 2 years. And they would qualify these buyers based on the teaser rate rather than the rate that it would revert to after the 2 years, even under the current economic conditions. They also wanted to have opportunities for tax evaders to become homeowners. And so they issued loans without having to document your income with tax returns. These became known as liar's loans. Most of these new loans were non-conforming, which means that the federal agencies, Fannie Mae and Freddie Mac, wouldn't buy the loans and syndicate them. Instead, a new breed of independent mortgage investment companies would buy mortgages as they were produced by the originators, and then they would package them into products that would be sold to fixed income investors. What they would do is they would take these loans, which mostly had no down payments, but then they would take the first 20% of the loan and market that as a high risk product that would take any losses from defaults before the rest of it. And then the remaining 80% was thought to be as good as a Fannie Mae loan that generally required a 20% down payment. And those kind of securities were rated AAA, the highest rated mortgage securities. The loans without documentation, that is, without tax returns, were generally rated as Alt A, and they were assigned a higher rate of interest. And because these things became so popular, Fannie Mae and Freddie Mac were forced to produce their own low down payment products. Starting in 2006, the mortgage boom started to run out of steam, and prices started to level out, and there would be more defaults, but the defaults were really minimized because these mortgage people were more than interested in refinancing practically anybody. So when they came to the end of the 2-year teaser rate and they couldn't afford the payment any longer, they'd refinance it with another loan with a new 2-year teaser rate and hope that conditions might be better at the end of that period. But by 2010, all these refinancing deals ran out. The prices were going down, so nobody had any equity left in their loans to refinance. And defaults shot up to a peak of 11% of all mortgages, which is huge. Pretty soon, people began to look into the true nature of the kind of investments they've made in mortgage securities. And they became scared and realized they'd taken on risks that they hadn't thought they had. And so they attempted to start selling these securities, but pretty soon the market dried up for any of these, especially the risky parts. But any mortgage thing was impaired. Pretty soon the lenders to some of the companies that were syndicating these loans found out that they've been unable to keep syndicating them. So they had a significant inventory of these loans on their own balance sheets, including the very high risk 20% that nobody wanted anymore. And so the lenders to these kind of companies, and they all had a considerable amount of short-term money as part of their capital structure, they refused to keep renewing their commercial paper when it would turn over, and it really put pressure on these kind of lenders. In March of 2008, Bear Stearns had to file for bankruptcy because of this kind of a squeeze. And pretty soon, the whole mortgage, any market that had anything to do with mortgage securities just kind of froze up. Nobody would buy anything. So there was no way of making transactions, and there was no way of really assessing what the real value of any of these securities were because there was no real market in them. If this wasn't bad enough, even commercial banks, lenders were starting to get nervous, and they were withdrawing funds when they'd mature, and these were very short-term funds. So. And there was nothing to replace them. Nobody else was willing to lend these banks money. And so in the next installment, we'll talk about how a bad situation got even worse.